thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today I'd like to welcome all of our Southern California Edison employees and retirees to this webinar. We're going to be talking about going over current market conditions. Throughout the course of this webinar, we'll talk about how inflation is impacting the market. We'll talk about the Retirement Group's value philosophy when it comes to selection process, how all this can tie into your retirement transition process. Now, with everything currently going on at Southern California Edison, we think a lot of these topics will be very appropriate for you. So with that being said, let's go ahead and dig into this. All right, before we do get into things, let's just remind everybody who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. We've been doing this for right around 30 years or so, and most of our advisors have a deep understanding of individual company plans. This allows us to help you avoid common mistakes we see from time to time. And our job is to help you make sure you maximize those benefits so you walk away with as much as you can from your company. We do have offices throughout the country, so rest assured if you need to sit down with one of us face-to-face, we can still accommodate that. Obviously, we can have phone conversation, web meetings, email, fax, all that's available as well. If there's anything to take us up on, I would recommend taking us up on our complimentary cash flow analysis. This is a detailed financial plan where we can run various scenarios to let you know if you're on the right path for retirement, whether you're looking at one specific retirement year or any other years. We can run those side by side, help you determine different pension elections, what to do with your 401k, and just generally speaking, make sure that you're on the right path. And we won't shy away from telling you if you need to work longer. But hopefully we can come back and tell you, hey, if you want to go earlier, you can. And we'll go through all those different parameters. But go ahead, that's something we can do for you complimentary, so just take us up on that. Now, as far as getting into the topics and looking at the market conditions, let's first talk about inflation, and we'll talk about government spending. Unfortunately, we've seen a lot of government spending. We've been talking about this for the last 2 years or so, especially thanks to the pandemic and the increased spending we've been seeing. And what that's led to, obviously, is going to lead to inflation. It's just taking a little bit longer than what we expected. But again, it has come roaring into the 2022 year. And we've seen quite a bit of inflation. We've seen historic highs since haven't seen them since the early 80s. And what that's also leading to is higher interest rates in bonds, pension interest rates when it's calculating lump sums, things like that. And then what that's also going to do is going to create different opportunities, whether it be short-term or long-term. Fearfully, it may also create higher taxes. Usually when we get higher government spending, there's only two ways to get out of it. It's to inflate your way out of it or tax your way out of it. So obviously we're going through the inflationary pressures right now. Time will tell us if we're going to increase tax rates to help mitigate some of that as well. But as far as retirement group, what we like to focus on more is going to be value investing when it comes to the stock allocation in your portfolio. We've been preaching this for quite a long time, but we've obviously been talking more about it in the last 2 years or so, especially leading into this inflationary environment. So let's talk a little bit about what the value philosophy is. We'll talk about what are growth stocks versus value stocks, and we'll also talk about an example as to if you were to go out there and buy a company on your own, how would you actually look at this? Now, as far as what is a value stock is actually something that you or I really kind of do day to day. Whenever we go out shopping, I say most of us probably, money's a concern. So whenever you go out shopping, you're going to look for the best value in the purchase you're looking to make, whether it be a car or a dress or even your groceries. You might look for coupons. You might look for something on sale. You want to make sure you're getting a bang for your buck or get your money's worth out of what you're buying. That's exactly what we do when we look at individual stocks as far as buying them, or use managers that actually purchase those as well. They want to figure out what's the best value right now. And generally speaking, that's going to be companies that have been around for a while. They're past that growth cycle and they're generating revenue. And a lot of times they have a lower price to book ratio or a price to earnings ratio. They tend to have more cash on hand to weather the storms, and they tend to pay higher dividends. So these are different things that will not eliminate the risk during a market downturn, but it will definitely mitigate some of that risk and soften the blow. And that's what we've been seeing so far here in 2022, where values finally kind of come back into favor. And we'll talk a little bit about what that looks like in just a moment with some charts. But ultimately speaking, if you're not going to do this on your own, you need to find money managers that have consistently done so and stick to their guns, because there are times where we've seen in the past in the dot-com era where a lot of value managers actually started buying growth and really kind of skewed the entire portfolio. So you need to be careful about that as well. As far as how's value versus growth looked, again, I mentioned what value stocks are. Growth is kind of the opposite. Usually it's kind of a company that's more in its infancy, where it's growing. It's actually reinvesting the capital or the revenue into itself, trying to grow it even more. So a lot of times those are younger companies. Sometimes they've been around for a while. They just think they can invest more wisely with their own money. whereas a value company is maybe kind of not necessarily run its course, but they think that it's worth paying a dividend for you to go out there and try and use those assets yourself versus them trying to just put money to work at something that may not be quite as favorable going forward. So we look at this historically. Since the dot-com crisis, you can see the blue line is going to represent growth stocks, and the purple line is going to represent value. So coming out of that dot-com crisis, when the growth stocks were beaten up, you can see value did better over that time period. Then once we moved into the recession of 2008 or 2007 to 2009, we saw both getting hit quite a bit, and since then, we've honestly seen growth outperform quite favorably. And one of the reasons there is because of the low interest rates we've seen historically. A lot of times, again, growth companies, if they can borrow money for next to nothing, which they've been able to do, they're going to continue to reinvest that. Whereas if interest rates get higher and it's harder to borrow, you'll start to see them suffer, and that's what we're seeing so far here in 2022. But if we take a closer look and go farther back, let's go about 3 decades and see what it looks like and how those gone in and out of favor going back to the 80s. If we look at this, you'll see the green is going to focus when value has outperformed growth, and the gray is when growth has outperformed value. So if we see back in the mid-80s or so, value was doing better, and then it wasn't until the 90s that growth started doing better, then value kind of came back into favor. So most of the 90s, they were kind of equalized until you get to the late 90s, and that's when that dot-com era started, and pretty much anything you threw a dart at was doing good because they were focused on high growth. But ultimately, that took a dive in 2000, 2001, and 2002. And then since then, value outperformed that dramatically because, again, a lot of the value funds were actually managers that were either holding cash or they were focused on companies that actually had a true value, not just those that continued to go up over time without even generating revenue, which we saw a lot of that during the dot-com era. And then since then, you'll see kind of the growth has outperformed more often. But there have been a couple years where value kind of peaked its head above, but we're moving into that transition now in 2022, thanks to inflation that we've been talking about. That value has greatly outperformed growth, and again, a lot of it's because it's softened the blow in the downturn. Doesn't mean it's been positive. It's been has not suffered as much as what the rest of the stocks have in 2022 so far. Now, as far as an example of how would I go out and actually buy a company, let's kind of run through a hypothetical example. Let's assume maybe you retired and you wanted to start a business, but you decided I want to buy a business instead. You had a couple $100,000 to invest, and let's assume that you found a flower delivery business. And when you took a look at the numbers, you looked at it and said that, okay, I've got $200,000 to buy this. If we look at the assets minus liabilities, there's no debt on the books. There are 5 delivery trucks worth about $160,000. There is inventory valued at another $10,000. So the book value is $170,000 for this specific business. So I'm going to pay $200,000. I'm getting $170,000 worth of items, if you would. But I'm also going to get some potential income. There's $30,000 of net income each year, and of that, the owner keeps $24,000. So if you look at that $30,000 in 1 year, that 170 plus 30 adds back up to the 200. So you're essentially kind of getting your money back out of it. Or you can look at the aspect of, okay, I'm going to invest $200,000 to get $24,000 a year off this business and still have assets. Then that definitely becomes a pretty good value. So it all depends on how you look at it, but you need to focus on this not just for a small business, but if you're looking at buying Apple or Exxon or something like that, you need to focus on the entire company and whether or not it makes sense to buy it. If you go out and look at it and say, okay, it's worth, let's say, $100 a share, but you look at the market, it's trading at 120, then it's not going to be worth buying it. But if it's maybe trading at 80, then you think, okay, well, it's worth 100. I'm going to buy it at 80, so it's on sale. And it may take some time, but eventually we'll get to that value, and that's where you focus on that true intrinsic value. Now, as far as looking at the inflation we talked about and how it's kind of reared its ugly head here in 2022, time will tell if it starts to subside or level off at least, especially going into these summer months. But unfortunately, high government spending has been one of the biggest culprits, and a lot of people may not even realize that if you look at historically and just adjust it for inflation, how much we spent on World War II, the entire war was estimates between $4.3 to $4.6 trillion. We spent about $5 trillion just on the COVID spending and relief there. Not to mention the additional bills that we've kind of gone through, obviously the increase in Social Security, Medicare, other government spending. So there's a lot of spending that obviously is driven to this inflation. And again, like I said, the question is going to be, we've gotten up to historic highs dating back to the early 80s. Hopefully we don't go too much higher, but eventually when we see see that start to level off and start to slow down, that's when we'll start to see some rebounds in the bond market, and we're really kind of looking at both inflation and earnings reports for the stock market at this point in time. Now, as far as opportunities to look at, again, it's going to be individual based upon the underlying holdings you have access to, whether it be in the 401k or an IRA or other investment opportunities. But there's different ways to capitalize. You want to look at, understand what's uncomfortable today can be beneficial for you in the long term, and then focus on what your actual goals are going to be for the funds, whether this is money that's geared towards a home purchase or if it's longer term for retirement or something like that. Every goal dictates a different asset allocation structure and investment philosophy. But as far as capitalizing on things, looking at the value philosophy, what you want to do is you do want to take advantage of price volatilities. We see these time in and time out. A lot of times there's also irrationality in the market to be aware of. You want to be careful and not get caught up in the herd. A lot of times everybody goes in the same direction, and sometimes you have to be patient and not greedy when others are, and take a true look at what that intrinsic value is that you're focused on. And if you're not willing to do this, make sure that you're focusing on managers that are not afraid to hold cash. What I mean by this is a lot of fund managers might have it in their prospectus that they have to be 95 or 97% invested. So even if they think the market's going down or they can't find anything worth buying, they still have to buy it just because the prospectus tells them to. We like to focus on managers that don't have those handcuffs, if you would. And we've seen more recently and other times in the past where if things were not of value and they couldn't find anything worth buying, they weren't going to buy just to buy. And they may sit on 10, 15, 20, 25% cash. So what that meant was when things took a hit, they were not hit as bad, and they also had that cash to pick up things when they're on sale. So you want to be focused on fund managers that will be willing to hold cash, and also they hold their own money in those funds, so they practice what they preach as well. As far as being comfortable, unfortunately, we're focused on value and looking for things that are on sale. A lot of times it may not be favorable right now, and again, you may say, hey, the intrinsic value is worth X, Y, Z, but it's trading at this right now, and it may continue to go down a little bit, but if you know that all your research has been correct, it'll eventually get to that intrinsic value. You will be making money on it, but again, it may take some time. It may be uncomfortable in the short term, but again, over the long term, it should prevail. And then ultimately speaking, we believe that if you have the patience and understanding for this, it's going to benefit you more in the long term, and it's going to also reduce your overall risk on the stock side of the portfolio. So another quick example as far as the value philosophy, just kind of wrap this up, is history shown the best time to retire is when stocks are on sale. Obviously, hindsight's 2020. We don't know exactly when that's going to be, but if you could have gone back and retired in March of 2009, that would have been the best time to retire because the market was at a bottom then. Maybe now, the market's pulled back quite a bit. It could definitely come back down more, but time will tell, and we'll see. And with inflation risk, this is a little bit changed now in the last 6 months, but right before inflation kind of crept in 2022, current dividends were actually paying higher than a lot of bond interest rates. So again, that showed you kind of where that value philosophy was. Obviously, interest rates are moving up with inflation, and we'll see bonds becoming more attractive over time. But again, we still want to focus on companies that have good dividend-paying stocks. And then at the end of the day, if you can control your emotions and you understand this for the long term, you will be rewarded as far as your investment approach there as well. And the best way to kind of tie all this together, unfortunately, we're not going to sit here and tell you, hey, you need to allocate your portfolio in this manner or that manner without knowing what your goals are. So you need to look at running a cash flow analysis. And right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about 10 minutes with us, maybe a little bit more, a little bit less, we can gather some data, find out what you're trying to solve for as far as your retirement spending needs, see where you are, and help you determine if you're on the right path to meet those goals. And that in turn can give us the big picture and tell you, are you allocated appropriately in your 401k or your other accounts, or should you make any changes? And what are some alternatives you may want to look at in order to get back on path for that specific goal? And at the end of the day, obviously, we'd love to make you a client. We'd love to work with you. But if not, that's still okay. We want to make sure we can at least help you out or help any friends out that have questions as well. But if you are working with somebody else, we respect that. And we do recommend getting a second opinion with us. We do also recommend our own clients get second opinions every now and then. What you do want to make sure is you are working with somebody that has a deep understanding of your specific company plans. So I can't tell you how many times we sat down with somebody who had an advisor of 10, 15, 30 years even, and thought they were in the best hands, and they didn't know the company's plan. And we explained to them, sorry, based on what you did last year, you walked away losing $30,000, or you could have gotten 30 grand more, 20 grand more if you did it this way. So again, even if you're working with somebody, let us at least take a look at it to make sure you don't make any mistakes or your advisor makes any mistakes. At the end of the day, you're going to be paying a fee, whether you stick with a 401k plan, work with us, or work with another advisory firm. Just make sure You understand that you're getting what you're paying for. Make sure you understand that fee structure. As fiduciaries of the retirement group, we are transparent on this. We're not a one-size-fits-all cookie-cutter firm. Our goal, again, is to run that cash flow analysis back into what you're trying to achieve and provide you choices and options and go over the pros and cons with those and go over the fee structure with those choices as well. And at the end of the day, again, you need to run that cash flow analysis to make sure all this ties into play and making sure that you are solving for what you're trying to achieve versus just a run-of-the-mill portfolio that somebody put together for you. Now with that, I do want to kind of wrap it up, and I want to welcome anybody to give us a call if they have any questions. You can always reach us at 1-800-900-5867. You can also reach us at info@theretirementgroup.com. And if you got your cell phone handy, you can hold up to the QR codes on the screen. There's one to schedule an appointment with myself or any of the other advisors across America with the retirement group. Or if you'd like to follow us on LinkedIn, you can also get into your company-specific LinkedIn page that we have, so you can stay up to date on not just everything, but your company-specific plans, pension rate changes, 401k changes, new webinars coming out, all that kind of detail as well. But I do want to remind everybody that, again, we are not employed by nor are we endorsed by your specific company. We are an independent financial advisory firm that has been working with many companies for about 30 years or so, and our advisors have a deeper understanding of your specific plan, but we're not employed or endorsed by them. So with that, I want to thank everybody, and I hope you guys have a great day. All right, again, I want to thank everybody for joining me today, and I hope you enjoyed that conversation on the current market conditions, the retirement group's value philosophy, and how it can help Southern California Edison employees and retirees with their portfolios. Now, I'm sure many of you may want to sit down or have a conversation with one of our Southern California Edison focused advisors. If you do, feel free to give us a call at 1-800-900-5867. Again, you can reach at info@theretirementgroup.com, or simply go to our webpage and go ahead and use that contact us feature there to get a hold of us as well. I hope everybody has a great day, and we look forward to talking to you soon.